Hi, I'm Al from the Money Study, bringing you another episode in our Take 10 Challenge, number 21. What is this thing, superannuation? What's it all about? Is it any good for me? Should I consider doing more or less with my thing called a superannuation? Before we get into the details, there's my disclaimer. It's all about facts, it's all about figures, it's information only, it is not advice. So, what is superannuation? Superannuation literally is just a tax arrangement. It's an arrangement where you've got an investment and that investment is then taxed differently than if the investment was in your own name. Okay? So it's just an investment, but it's the superannuation of the tax box that covers that investment differently than if you had the investment in your own name. It's basically the government have decided that superannuation is for your retirement. They've actually spent a lot of time over the last few years coming up and saying, yep, we've decided that superannuation is for your retirement. I mean, duh, we knew that. Why would they go to such an inordinate amount of time to specify, all these years later, to specify what is super for? It's because then they can basically argue the point that if super is for your retirement, then you need to take it as a pension. And whether lump sums, we're going to talk about this in future sessions, will you indeed be able to get a lump sum out later on? Or if you did, will it be taxed? So a lot of questions in the future, which hopefully we'll try and address day by day. But in theory, superannuation for most people is a beneficial way to invest our money. Yep, it's preserved, meaning that any money you put into super these days, it's locked up until your preservation age. And at the moment, if you are under 60, then by the time the 1st of July rocks around this year, your preservation age is indeed 60. So there used to be a sliding scale, but the sliding scale runs out on July 1 this year. Everybody's preservation age going forward will indeed be 60. Now, that's not to say that the government couldn't change that. They have a way of fiddling with super so many times it becomes annoying. The younger people just don't have a lot of faith in super, literally because the government keeps on changing the rules on something that might happen in 30 or 40 years' time. They need to sort of work out what they're going to do and leave it alone. Now, the best part about super, well, so this preservation age, it could be a good thing, or it could be a bad thing in the regard that it's a good thing in the regard that it's like forced savings and we can't touch it. We can't get it out until this time in the future at 60 when we've retired. So for someone who's poor at saving and keeps on dipping into their savings, superannuation is at least forcing us to save for our retirement. But the best part about it really is the fact that the government has legislated that now that every employee should receive what's called the super guarantee amount, currently 11%, scheduled to go 11.5% as of July 2024. So going up another 0.5% on its way, in theory, to 12% by 2025. Now, if you're working for the Australian Public Service, they get a mandated 15.4%. So, tad unfair, dare I say. But, this is the public service. So they get 15.4%, whereas everybody else working at Bunnings or whatever gets 11.5%. But by having that contribution go in, a younger person starting off, at 18 and getting nearly 12% of their salary all the way for the rest of their life, this is indeed going to give them a fairly, a long way towards providing for their retirement. Now, the thing what really sort of I find quite amazing is that people blame super when things go wrong. During 2008, I had all these clients coming to me and say, well, why on earth would I put more money into super? It's going backwards. Super's useless. No, super's not the problem. Super itself will never go backwards. It's the investment you've chosen inside your super fund that can go backwards. So you can choose how the money is invested, but the vast majority of Australians don't. They just put it, they let the super fund choose, and that's the end of the story, without understanding the risks involved of their particular portfolio. Now, again, we're going to talk about all of this over the next year or two as we go through these sessions one after the other. But you get to choose what fund you can use, generally speaking, because there's now freedom of choice of super funds. You get to choose what investments you've got, whether they are very risky or very safe or somewhere in between. You can change them. Nothing's locked in. You can change your investments with many super funds within 24 hours. You can choose to have death cover or total permanent disability cover. You can choose to have income protection with with most super funds. You can choose who the money goes to as your beneficiary. So you've got a lot of choice, and pretty much the same sort of choice that you would have if you went out and got an investment. You've got exactly the same in super. It's just that the superannuation fund gets taxed differently and, dare I say, beneficially. But of course, the whole thing is that, before we start shoveling too much into super, is it appropriate for you? And of course, this whole how old are you is one of the biggest impacts on this. Now, someone closing in towards retirement, superannuation can really be almost a no-brainer in the regard that it's taxed effectively. You're only locking it up for a few more years, and any money that you've got into super, well, then later on, it can indeed be moved to things like these tax-free pensions and so forth, which we'll indeed talk about. But it's certainly, so for an older person, superannuation, generally speaking, pretty appropriate because you're not locking the money up for too long a period. Younger people, you've got this problem where you're only 18 years of age, you're still 42 years away from being able to access it. And of course, an 18-year-old is preservation age still going to be 60. As we all live longer and get older, and as the government is struggling for money, they get into too much debt, and so it goes on, that they may indeed raise the preservation age like they did once before. Preservation age was set at 60 when, it was set at 60 years when age pension was 65. Now age pension for Centrelink purposes, old age retirement, gone to 67, 8 years of age, so we could probably expect to see preservation age at least sneak up by another couple of years there. But look what happened in France, where they tried to raise the age of retirement up to 62, and there was almost blood on the street. Australians just seem to either don't listen, don't care, or they say, oh, well, that's one of those things. As I said, the preservation may be a positive, there's like a forced savings, but it may be something that's if you're a younger person looking to save money for a deposit on a house, if we put the money into super, we've got a problem. Having said that, there is a scheme allowing you to put money into super and using it for a deposit. We'll talk about that in a future session. But generally speaking, if we've got a shorter term goal, if we're trying to save money to put our kids through private schools or whatever it may be, then super's not the reason if we're going to need that money before our preservation age. And as I said, legislation changes, goodness knows what they're going to do. They keep on changing it. But the best part for most people, now not everybody, but the best part for most people is that your investment, this is where the money gets invested inside your super fund, it will get taxed just like you get taxed if you had an investment. But the tax rate for a super fund, irrespective of whether you're 20, 50, 80, whether you're working or not, any money that's in a super fund, effectively the earnings are taxed at 15%. And even capital gains tax is only 10%. So the tax benefits of super is that you can have a large lump of money and you could earn 10% on your money. You could have $1 million earning 10%, $100,000, and you'd only pay 15% tax on that $100,000. Whereas if you were on an income, of 200,000 or so in the highest marginal tax bracket, you could lose nearly half of your earnings in tax outside of super. So it comes down to what are you earning. See, someone earning less than 18,200, as we learnt from our session there on tax brackets, they don't pay any tax. So their money in their bank account wouldn't attract any tax, nor would any investment because it's under 18.2. But money in a super fund, irrespective of what they're earning, and if they're earning less than that, they would actually indeed still be paying 15% tax, even though they're underneath the tax-free threshold, because super is outside of their own personal things. It's owned by the super fund. The super fund is a trust. You just happen to be the beneficiary of the trust. So now, also super funds, because we call them a wholesale investment, meaning there's you, but there's also a couple of hundred other thousand people in this same super fund. So there's a couple of 100,000 people perhaps that the super fund then invest all of that money. So these guys can then go to an investment and say, look, I've got 200,000 people that want your investment. They get discount. It's like a wholesale rate for the investment. And with most of these funds, things like an industry super fund where they're not for profit, then effectively you get the benefit. So generally speaking, the investment fees are a lot cheaper inside a super fund than if you tried to turn around and do exactly the same investment by yourself. Okay, we'll talk about the different types of super funds later on. When you see the advertising between an industry fund where they use that hand signal to explain that you'd have more money, we'll go through that in another session. If you were to have your employer pay the super guarantee amount, that employer amount, into your super fund, generally speaking, you can get some insurances like death cover and so forth without even have to do some underwriting. I mean, you don't even have to fill out a medical questionnaire up to certain limits. So for someone who doesn't have any insurance and really would like to get some but might be knocked back because of their health, just have a look around for a super fund that provides you with good insurance so long as your employer pays into the super fund. We can salary sacrifice. We're going to talk about that in a future session, where we can put money into our super fund before we even get taxed and reduce our tax bill every year. Co-contribution, we're going to talk about that, where effectively a low income earner can indeed contribute a little bit of money to their super fund and the government gives them a bit of up to a 50% matching. So there's all these sort of little other tricks that we can do just by putting the money into super. That's the situation. Now, a lot of financial planners say you should be saving at least 10% of your income all the way through your life to have some sort of chance of retirement. For most people, that's sort of snuck up to 15 to 20%. But even so, as I say, if your employer's doing it all the way through, and of course, females, we find that they get sort of left behind if they're the primary carer. But it just depends on, how many years you are working out of your working life. Make sure you know what your employer is paying you and should be paying you. I say it's 11% of your gross. That's the amount of money before you get taxed. So if you're on 100,000, they're doing 11%. They should be 11,000 or so going into your super fund. Now, remembering that just because they say on your pay slip that the money went in, did it? Did it actually go in? Have a look at the transactions on your super fund to see whether the money went in. Now, in the past, it was a case that the super fund, the employer can put it on your pay slip that they are indeed putting it in every fortnight, but they really don't have to put it in up until once a quarter. I think there's legislation trying to change that, so as soon as they say it's been put in, it has to. That it would be a good thing, so you get the interest on the money more regularly. But I say certainly over a year, you certainly want to look at your super fund for last year to make sure that you did indeed get that percentage of your salary over the year. So it's I get to see it too many, and because you see it in the paper, stories about companies that haven't been paying their entitlements to their staff. Just check your payslip, see what it says on your payslip, and see whether that amount of money is indeed gone in. Now, if it hasn't, of course, start talking to your employer. That's the first thing. And get a login. you know, most super funds will offer you get a login, and so you can see what's going on. Read your statement. We'll be talking about that in the future one. A lot of super funds have an app these days on your phone, so it's quick and easy just to see what's going on there. But if you're concerned you're not being paid the right amount and you're a little bit reluctant in talking to your boss, well, you certainly can, you know, check it through the this ATO, the tax department there. Got an unpaid super page to give you more information. You can complain to the Fair Work Ombudsman if you really get into strife there. But yeah, there are certain ways of recouping if they haven't. Your employer will get fined effectively if they haven't been doing the right thing, that's for sure. Make sure your super fund gets your tax file number. I mean, usually that's pretty common sense as you're filling out the form, they'll ask you for it. But if you haven't, then we've got this situation of different taxes because they don't know who you are. Now, remembering these days, of course, that if you change, you don't have to change the super fund every time you change a job. Years gone by, it was a case that your employer might have had a super fund and you virtually had to use it. So you go from one job to another and keep on picking up super funds. These days, with the choice of super, effectively you can go from one employer to the other and take your super fund with you, making sure, of course, it's a good one that you're taking with you. You might want to compare, and we'll talk about comparing super funds, obviously, in another session coming up. We're going to go through a lot in super. There's a hell of a lot to know, but I tell you what, the more you know about super, the more you'll like it, and the more advantageous, more ways we can take advantages of the scheme. Anyway, we'll talk about all these things in upcoming sessions.